All right, let's talk about Cummins. From an investor's perspective, this global power giant is at a fascinating crossroads, a real make or break moment. We're going to break down exactly how this 100-year-old company is using its old school business to fund a massive, and I mean massive, risky bet on the future. And this really is the core question, right? For a century, Cummins has been the king of the internal combustion engine. But now, with the whole world shifting towards zero emissions, how does a company built on diesel pivot without, completely imploding? That's the puzzle we're going to unpack today. The best way to really wrap your head around Cummins today is to think of it as a company with a split personality. It's basically a tale of two different engines, both running under the same roof. You've got the legacy business that built the company, and then you have this high-tech bet on what comes next. And as we're about to see, one absolutely cannot survive without the other. And here's that split, laid out plain and simple. On one side, you have the legacy core. This is the Cummins we all know, a super profitable, cash-generating machine. On the other side, you've got the future bet. This thing is high growth, eats up a ton of capital, and right now it's losing a lot of money. The entire investment case for Cummins really just hinges on the delicate balancing act between these two sides. So let's start with that cash-generating core, because this is the engine that's paying for everything. I mean, everything. It pays the bills, it pays the dividends to shareholders, and most importantly, it's footing the bill for that huge investment in the company's future. And the scale of this legacy business is, well, it's just staggering. Just look at this revenue breakdown. The engine, components, and distribution segments are absolute giants, each one making up about a third of the whole company. And then, way over here, you see this tiny little sliver? That's Accelera, the company's entire future, sitting at just over 1%. I mean, this visualizes the challenge perfectly. How do you grow that fast enough to one day replace all of this? Okay, this performance snapshot tells the whole story. You can see the trucking market is in a bit of a slump, and that's hitting their engine and component sales. But then, look at power systems. Revenue is up a whopping 19% with a phenomenal 22.8% profit margin. And then, you scroll down to the bottom, Accelera. It's losing 95 cents on every single dollar of revenue. This shows you exactly what's happening. One booming part of the business is cushioning the others, all while funding this massive cash burn for the future. So this is the crucial plot twist. The unexpected hero here is the power systems segment. Why? Because the global demand for electricity to power AI and data centers is just exploding. And guess what all those data centers need? Yep, reliable backup power, which is exactly what Cummins sells. This isn't just a temporary boost, it's a massive long-term trend that's providing a huge profit cushion for the whole company. It's basically the secret weapon that's funding this entire transition. Okay, so now let's flip over to the other side of the personality, that very, very expensive bet on the future. This is Accelera by Cummins. It's the company's big answer to the existential threat of decarbonization, and they hope their ticket to a whole new era of growth. So what in the world is Accelera? Think of it as the company's innovation lab for everything zero emissions. We're talking battery systems for electric trucks, hydrogen fuel cells, and, this is a big one, the electrolyzers you need to actually produce green hydrogen. This is where Cummins is placing all its chips for a world after diesel. But wow, is building the future expensive? In just a single quarter, Accelera lost $100 million. That number is just stark. But for an investor, it's so important to see. It shows you the sheer scale of the cash they are burning to build this business from scratch. It also tells you just how strong that legacy business has to be to sustain these kinds of losses, probably for years to come. So how is Cummins planning to get from its profitable present to its zero-emission future without falling into a massive gap in between? Well, their whole plan is called the Destination Zero strategy. And really, it's all about building a bridge. The blueprint for this bridge is what they call the dual path approach, and it's actually pretty pragmatic. Path number one isn't about ditching the internal combustion engine tomorrow. It's about making it cleaner, getting it to run on things like natural gas or even hydrogen. Path two is the big reap. That's the investment in pure zero-emission tech, like batteries and fuel cells through Accelera. It's not an all-or-nothing bet, and that's a really key part of how they're managing risk here. And these technologies here, these are the actual planks of that bridge. Their new fuel-agnostic engine platforms are frankly brilliant. They can build one base engine and then tweak it for different low-carbon fuels. That saves a ton of money. They're also working on hydrogen combustion engines, which lets them use decades of know-how.
You combine that with the electric powertrain tech they got from buying Meritor, and these are the real-world products that are supposed to keep the cash flowing during this long transition.
And as you can see on this timeline, they've been making some very deliberate, very strategic moves. Back in 2022, they spent almost $4 billion to buy Meritor for its critical tech. In 2024, they spun off their filtration business to raise cash and sharpen their focus. But for investors, this is the date to circle on your calendar, 2027. That's the year they're targeting for Accelera to finally stop losing money and break even. It's their public roadmap.
Okay, so we've seen the two sides of the company, and we've seen the strategy to connect them. Now let's bring it all home to the investor's bottom line. What are the real bull and bear arguments for this stock? First, just a little context on valuation. If you look at Cummins' PE ratio, it's kind of right in the middle of its peers. It's not as expensive as Caterpillar, but it's not as cheap as some of the pure-play truck makers either. So what does that tell us? It tells us the market is trying to figure this out too, balancing that steady old-school business against this unproven high-growth bet.
So really, it all boils down to two completely different stories you could tell about this company. The bull case is that you have a technology leader that's smartly navigating this energy transition, with the whole thing being supercharged by that AI data center boom. The bear case? It says this is just an old-school cyclical company that's facing a downturn and is risking billions on a transition that is incredibly difficult and might just fail.
And that leaves us right here with the ultimate question for any investor. When you look at all the pieces, the profitable legacy core, that booming data center business, and the very expensive but maybe promising future in Accelera, what do you see? Is this a classic industrial company that's just temporarily undervalued as it transforms into a clean energy leader, a deep value play? Or is it a value trap, a legacy giant pouring good money after bad into a future it might never reach? That is the billion-dollar question.